Hello fellow traders. Today we're diving into the power of historical data analysis to uncover winning patterns in the stock market. We'll focus on the SPDR S&P 500 ETF Trust, or the SPY as we call it, and explore how tools like the Money Flow Index, MFI, can enhance our analysis. Today we're going to get into analyzing historical data to identify winning patterns by a pajama trader. Give this a like and subscribe, and let's get ready to unlock the secrets of successful trading. Why analyze historical data? We analyze it to identify recurring patterns, understand the stock market behavior, improve decision making, and enhance risk management. Historical data is our roadmap to the market behavior. By studying the past, we can better navigate the future. It's not about guessing, it's about recognizing patterns that have consistently led to success. In trading, knowledge is truly power. Key components of historical analysis. We have price movements, volume trends, technical indicators, including the MFI, and market sentiment. When analyzing historical data, we're looking at complex interplay of factors. Price shows us where the market has been, volume tells us about the conviction, and technical indicators like the MFI help us identify trends and potential reversals. Remember, market sentiment is the emotional undercurrent driving significant moves. Case study: SPY's historical patterns. Let's examine the SPY's historical data. Notice how it respects certain levels. Look at the bell icons on the right side for reference. Notice the support and resistance levels. These aren't random, they're psychological price points. Pay attention to the seasonal patterns and economic correlations. The MFI can provide additional confirmation of these patterns, giving you an extra edge on your analysis. Keep in mind of trend analysis, support and resistance levels, and seasonal patterns. Also, correlation with economic indicators, and MFI signals for confirmation. Winning pattern, the Golden Cross. One of the most reliable patterns is the Golden Cross. It occurs when the 50-day moving average crosses above the 200-day moving average. In March 2024, the SPY demonstrated this pattern, signaling the start of a bullish trend. The MFI, rising above the 50, provided additional confirmation, and traders who recognized this pattern early had the opportunity for significant gains. The 50-day moving average crosses above the 200-day moving average. The strong bullish signal accompanies that, and the SPY Golden Cross happened in March 2024, along with MFI rising above the 50 as additional confirmation. How to identify patterns? Using charting software, applying multiple time frames, combined with fundamental analysis, and incorporate volume-based indicators like the MFI. Practice, practice, practice. Identifying patterns takes practice. Use good charting software and look for multiple time frames. Don't rely solely on technical analysis. Combine it with fundamental analysis for an in-depth view. Tools like the MFI provide valuable insights into volume trends. Remember, the more you study these patterns, the better you become at spotting them in real time. Implementing your findings. Develop a trading plan. Set clear entry and exit points. Use proper risk management. Keep a trading journal. and use the MFI for confirmation. Once you've identified a pattern, it's crucial to have a solid plan. Know your entry and exit points before you trade. Always use proper risk management and never use more than you can afford to lose. Keep a trading journal to track your successes and learn from your mistakes. Consider using the MFI as an additional confirmation tool for your entries and exits. Real life example, SPY breakout. Let's look at the real example from the SPY's recent history. In Q3 2024, SPY was consolidating in a tight range, if you can see on the chart here. In October, it broke out above key resistance levels with strong volume. The MFI confirmed this breakout by showing increasing buying pressure. Traders who identified this pattern acted and rode the subsequent uptrend for substantial gains. Common pitfalls to avoid. Over-reliance on a single pattern or indicator. Ignoring the broader market sentiment or context. Failing to adapt to changing market conditions. And emotional trading. While patterns can be powerful, they're not foolproof. Don't rely on a single pattern or indicator. Look for confirmation from multiple sources. Also consider the broader market context. Be prepared to adapt if your strategy or market conditions change. And most importantly, keep your emotions in check. Your path to success. Continuous learning, patience and discipline. Embrace technology. And join a community of traders. Success in trading doesn't happen overnight. It requires continuous learning, patience, and discipline. Embrace technology to help you analyze historical data more efficiently and effectively. And don't go at it alone. Join a community of traders, like this one, and share your insights and learn from each other. Remember, every master has once been a beginner. Keep studying historical patterns, keep practicing, and success will follow. Thanks again for watching.